And we are live. Awesome. Well, welcome to Interchain Live. This is the 11th time we've gone live talking about cryptocurrencies, blockchain technology, specifically looking at how it can really impact my local community here in Vermont. But the key is these technologies are global. And so in some of my outreach, I came across some brilliant people. And most recently, I've met Brendan Jaggers, and we met down at the Dallas conference. He's with St. Edward's University. He's a senior there. He's working on his thesis and has some really insightful ideas around Bitcoin market and cryptocurrency markets. And so I'll let you take it from here for a sec. Let us know a little bit more about the work you're doing, Brendan, and what brought you into, I guess, what brought you to it?
So thank you. So basically, I started off in the cryptocurrency by a phone call, and my buddy said, "Hey, Bitcoin's at $1,000, and what do you think about it? Should I invest and stuff like that?" I was like, "Well, I don't know too much about it. I guess supply and demand models, maybe. You put in a little bit in there, and don't put in anything you're about to lose in there." But he's like, "Well, have you heard anything about mining, like making this stuff?" It's like, "No, I haven't really looked into it." So I went ahead and looked into mining, and I became a miner first and investor second. So that's kind of where I put my basis at for the most part. And I going through mining, I wanted to know, because there's lots of different types of miners out there. There's retail miners that have maybe 1 rig to maybe 5 rigs in their basement, garage, or house, and then there's mid-cap miners that have like a storefront full of these things. There's about 50 of them or maybe 100 of them, and they have very good electricity rates, good cooling. And then there's, large scale, just big manufacturing warehouses. They supply their own energy, stuff like that. So I was wondering, like, well, with all this capital coming into cryptocurrencies on this side of the spectrum, how does it affect the price of Bitcoin at all? Does it influence in some way? And so I just wanted to ask, do miners play a role into the price of Bitcoin somehow? So.
All right. Yeah. Awesome. So, I mean, I think it's a really, really valid question. Obviously, it's a key component to the network, the mining that goes on. It's what secures the network. So you started mining. What was your initial foray? What were you running?
So I looked on Bitmain, and it was, and apparently they were the only ones that were selling Litecoin. So I was like, well, Litecoin seems pretty interesting. I'm gonna go ahead and try that one. And I bought a L3 Plus, Bitmain L3 Plus, and it was successful. It came through. Actually, what's really funny is I saved up a lot of money to buy it, and then I looked on is Bitmain a scam? And believe me, I found all the documentation saying Bitmain was a scam, and I had sent my money all the way over to China. The banker told me, like, hey, if you send it over to China, you can't get it back. We can't help you. I'm like, oh, okay. And then I go back home, like, oh, I saw all these articles that, Bitmain robbed me of this, that, and the other. So I just crossed my fingers, and next thing you know, I got an email saying, hey, your miner's getting shipped out. 7 days later, the miner came to my door, and I plugged it up. I was happy, really, really happy seeing this thing. And I was like, wow, I'm glad I did not get scammed by any way. And so I did that, and as Litecoin was going up to about $200 to $300, I went ahead and sold my machine.
All right.
So
yeah,
it was a lot of fun learning how everything works with this stuff.
Cool. So now, did you really use some of the data from that experience to inform what you're doing now, or have you found really it was more beneficial to really look for other sources of data?
So when I was mining, all my research was going into like, how does mining work? How can I get the most out of mining and stuff like that? And then I went on to a website just kind of seeking out the miner equation. So instead of calculating using other websites saying like my speed is this, what return do I get based on your data, I wanted to do it for myself. So I went ahead and put it into an Excel spreadsheet, and I started playing around with the miner equation. And then I went further and started asking, well, I know we're going to hit this difficulty level. So like maybe it's at 1 trillion. Now we're aiming for 1.5 trillion. So why don't I just make this into an Excel and just ask it, what's the return at 1.5 million? Because I'm at 1.5 trillion level of difficulty, assuming all things stay the same. And then from then on, it was a giant rabbit hole. And then I was like, wow, actually, there's more questions you can ask for this question, once you start dissecting it and changing it around. And then I went ahead and looked on, I wanted to compare hash rate and the price on a chart. And what I found was very, very interesting. Now, I don't know if am I able to show the...
Yeah, you should have a little green, if you float over the top left of your screen, it should be a screen share link. And from there, you can pop up and share a window or your whole screen.
Okay. Entire screen, share. Okay, so we got it here.
Oh, now you're sharing me. There we go. Cool.
Okay,
Let me pop you back there. All right.
So what I did was I looked up, the relationships that this whole graph here has here at the bottom, and I clicked on hash rate, which in my opinion is just basically how many people are on there on the network.
Right.
And then its price. So then I put this on a log scale. Let's look at it on a linear scale. On a linear scale, it looks too noisy. Didn't really make much sense about it. But on a log scale, which basically makes two data sets pretty equal to each other, then I started noticing something pretty cool. I was like, wow, these look like bounce points. Any sort of person who does technical analysis, which is like, oh, hey, these are key little bounce points and stuff like that.
Right.
And so then I went ahead and looked on to other coins. Like, well, does this still happen on other coins? And it sure does. The price is here in the bottom, and the network hash rate is that kind of fuzzy line at the top. And I sort of came up with a conclusion that states when the price exceeds the network hash rate, miners are getting overpaid for what they're doing.
Right.
When the price is lower than the network hash rate, let's say down here, miners are typically getting underpaid for what they're doing. And now there should exist a nice, fine balance between network hash rate and price, that miners are getting paid a fair return for the work that they're doing.
And that has to do with capital management, whether or not they liquidate as soon as they collect their coin versus holding it.
Yeah, no, that can have an effect on there too. But based on these charts, won't be able to tell you whether or not what the capital management would be doing.
Right.
But I went ahead and looked on, and these relationships do exist on different coins and stuff like that. So I was like, well, should probably look into this. So in doing so, I figured, well, if I'm able to calculate a fair return for a miner, then I might be able to calculate a fair price for Bitcoin instead of it being overpriced or underpriced. So I want to go back over here to the Bitcoin chart. Let's see, right down here. Let's go zoom in over here. So right around here, the chart has it right at 19,000 and for $400,000. So during this time, I believe everybody knows that this was going way too high, way too quick, and the price was simply overpriced. I feel like we all knew that.
Right.
But as a miner, getting paid $60 a day, $45 a day, I think that was a little overpriced, in my opinion.
Sure.
And I was wondering, it's like, wow, this, if miners are getting overpaid right now, of course, doesn't mean the price is going to be overpriced, and sure it was.
Yeah.
So there must be some sort of relationship between these two, and that's kind of what I seeked out to do.
Yeah.
So let me further go in here. So I went ahead and wanted to see as the difficulty increases. The difficulty increases because, well, simply because more people are getting onto the network, pushing the hash rate up, and solving blocks faster than 10 minutes. So let me share this. Oh, can y'all see the screen? It's all white?
Yep.
Okay.
All white. Some bars on the left.
So as a retail miner, I decided that usually running a S9 should run you about, that's a Bitcoin miner, by the way. Running an S9 should run a retail miner, someone who's a hobbyist, someone who's having this in garage, typically about $100 a month in costs. So I said, well, about $100 a month, if I get, let's say, $5 a day. So at the end of the month, at the end of 30 days, it should be $150. Now, if it costs me $100 to run, to run the machine at $50 profit, well, that's starting at the very start of making an investment decision. And an investment decision meaning, do I unplug my miner or do I not unplug my miner? Do I, want to keep on mining or do I not? So at $5 a day for retail miners, that's pretty much right where it's about to happen, based on 12 cents or 10 cents per kilowatt hour. Some people pay higher, some people pay less. But assuming $5 per day, miners are getting paid $5 a day. Here's the actual price right here, and this is data taken back from 2017, September 1st, and the actual difficulty. Well, what if as miners are getting paid $5 a day, that bare minimum, what would the price of Bitcoin have to be in order to make that $5 a day? Well, the price of Bitcoin would actually have to be $1,261. And I'll show you here that it does change dynamically right there. Oh, what was that? What? Anyways, let's change that back. Why did this chart come over here? Okay, that's not important. So anyways, so as more and more people come on to the network regarding this $5 barrier, essentially, this is the barrier to where miners will start to unplug their machines. If you notice on this column, the price is starting to increase. So this threshold that miners that will make that start making that investment decision to pull out is increasing and increasing and increasing, and went down a little bit because the difficulty went down, but then again skyrocketed as difficulty went back up.
Yeah.
At this price right here, when it was hit 16,326, if the price of Bitcoin were to go to $2,259, miners will be making $5 a day, which retail miners will start making that investment decision to whether or not to support the network or turn off the miners and get off. So what that leads me to is markets. People who start buying and selling and just simply invest into the market. Their investment decision, if they're in the red, lasts between 1 day and probably the end of that day, usually, but probably the most maximum 5 days. And at the end of that 5 days, you either consider yourself a holder, a hodler, or you're in it for some other different reason, or you pulled out, or you did something else. But usually about 5 days, if you're in the negative for typical investors, for traders who stick around and market, people who buy and sell, that's typically the threshold if they're going negative consistently for 5 days. My opinion, I think miners, they can definitely withstand going negative for a lot longer than investors can. Meaning they can withstand making $50 at the end of the month. You know what? That's fine, but that's for 30 days doing so. So even at $5 a day, the retail miners are the first ones to start making that decision. But at the same time, they're probably still going to stick on, given they're not they're still going to stick on a lot faster than traditional investors will hang around, especially at that price. So in doing this, I figured that there's some proof here that as more people come onto the network, this threshold has to increase and increase and increase. So let's go over here and
can you see other correlations where the decrease in the price causes the change in difficulty on the network?
So your question was changes in the price causing a decrease in the difficulty.
Right.
Let's go back over here. I would say no. The only thing that changes in the price, and the only thing that really would impact difficulty is if the last 216 blocks that got mined, I believe it's really just hash rate. As more people come in, as people come in and stuff like that, as they should increase or decrease the difficulty accordingly. Now we know that hash rate is actually rising predominantly pretty fast right now. It's not slowing down, and the difficulty is going to be creeping up. But the difficulty set actually on 2016 blocks as an average hash rate. Right. So if it's above some certain average, then difficulty will raise. If it's below, then difficulty will go down. And as that goes into what exactly is the fair return for a miner. What is the fair return for this miner exactly? And whether or not miners are getting overpaid and or underpaid for the most part. And I wanted to bring your all's attention over here to this section of the Google Sheets right here. I'm going to go ahead and look at the current return for an S9. Going to so here, I went ahead and picked power cost down to 0. So this would be net. So right here, we have a $10,633 Bitcoin, and the profit per day as of right now is going to be $12.45. So if you go back over here, I did a lot of good stuff over here, and then input here, $12.45, and then go ahead and put this all at $12.45. we should arrive at a 10,635. So I was like maybe a couple dollars off. So from over here. So
Yeah.
to show you that the equation from which you manipulate around it can work, I went ahead and said at this difficulty, which is where we're at now, about 3 trillion, what would it be at 3.8 trillion? Well, we would have to maintain this 12.45 daily income. Well, we would have to have a $13,664 Bitcoin in the future.
Right.
We would have to do that in order to maintain this. So, but if we didn't, if we were to maintain, this $10,000 Bitcoin and stuff like that, I have another calculator over here on the side that will tell you exactly what will be the return, which will be less than $12.45. Now, how low can that go? Will miners feel like they're getting underpaid? That's a different story. But I just wanted to show that, if you need to maintain, based on today's statistics, this $12 a day, then you would have to increase the price of Bitcoin as difficulty comes up, because the production of these S9s, they're not stopping. And I don't think people are not going to just say, hey, difficulty is going too high, let's unplug our miners. That's not happening. We're going to be hitting 3.8 trillion sometime soon. And if you want to maintain this level right here, if this right here is considered to be the fair price or fair return for Bitcoin, then up here would be the fair price in the future to maintain this income right here.
Right.
So that answer your question a little bit? Or?
Yeah, definitely. Let's see, what else was I gonna? Because I noticed. So yeah, I was gonna point out this section here between November, December lines, where you've got the deep dip in the hash rate with a little bit of a dip in the price there, right?
Mm-hmm.
So I guess my question would be, in an instance like that, was it actually the hash rate that precipitated the dip in price, or the dip in price that precipitated the hash rate? Do you recall what was going on there? Because I remember that was during the whole SegWit 2x conversations that were taking place.
Oh, really? So there's sort of two things on this. If hash rate does have a direct impact into the price of Bitcoin, and I actually hope it doesn't, but if it does, then people like Bitmain or people who have big mining farms, they don't even need to shut off their machines. They just need to turn off the internet, which is probably way more cost effective to do. And this would have an impact on the price. Would you want people like them to really have that much of an impact on the price?
Sure. I mean, perhaps not. I mean, that's a very good question. The question ends up being like, how much of the coin are they actually holding versus liquidating? If they've liquidated everything the moment they've got it, then they don't have a whole lot of incentives to protect the value of the coin in the network. But if they're holding a portion of their proceeds consistently, well, then they have a vested interest in the network. So maybe they do have good reasons to not manipulate the network in that way.
Right.
But that's a really good question to bring up in terms of, how centralization can be impacting.
Right. And my question, my theory would have to state whether or not, miners have a direct impact into the price of Bitcoin, or they have a heavily big influence onto the price of Bitcoin. And I do want to show you over here on this other sheet right here, based on today's statistics. I say that the miner cutoff limit was $5. It's all at $5.
Right. Yep. There you go.
So in the future, we actually need to hit a $5,487 Bitcoin once we hit this difficulty level to maintain a $5 gross income. Right.
Which we're basically, the difficulty level we're at now is where it's bold, right?
Right. Yes. At the 3 trillion mark. So right now, our minimum Bitcoin that miners would ever accept is, 4,271. After it goes right down to $5, anything below $5, most miners, hobbyist miners, retail miners are going to start making that investment decision whether or not they can maintain the network. And there's another part that I wanted to discuss was during the SEC CTFC meeting, there was a part into the film that I forgot what the question was, but they basically cited that the economists that work for them cited that the cost of mining a Bitcoin, the miners themselves have a strong correlation to the price of Bitcoin. And I believe this is probably one of the ways that is strongly correlated into it, that miners do have some sort of very strong correlation into the price of Bitcoin. And here I want to find a minimum for that.
Right. Now, I mean, the question for me comes down to, though, is that really an argument? Is it an argument for there to be concern about miners having that influence, or is that really just an argument for more people to get involved in mining?
I would no, I would be concerned. I would be concerned if miners have a direct impact on the price of Bitcoin, then they can be manipulation, and then after that, they'll lead to price arbitrage everywhere, and that would, that wouldn't be good. And people like Bitmain, well, they would have a huge hand into the price of Bitcoin. And
well, to that point, though, so here's the thing. How long has the S9 been out?
About a year and 4 months.
About a year, right? So at a certain point, the S9 becomes obsolete. And no matter who you are in the market, you've got to end up upgrading in order to continue competing in terms of power consumption versus power production.
Right, but all these miners,
or hash rate.
All these miners, they're not mining solo. They're mining via pool. So
right. But what I was getting at is that, we're at a point where more and more people are becoming aware of Bitcoin and cryptocurrency. And if we have enough demand globally, not only can we be sourcing the new people coming into the market to mine can be buying the latest miners, which would be more competitive than what's out there running now, but also we can be identifying, like, Bitmain is sort of the place, but the SHA-256 algorithm isn't theirs alone. We could, if us American engineers were innovative enough, come up with an ASIC chip that's actually efficient and we could produce, we could be making something stateside that would compete in this network as well.
Sorry, we have a meeting in here.
I'm sorry, guys. I believe I might be in a room that people reserved, apparently.
Oh,
I'll right phone out real quick.
Yeah, no, you're fine.
Ooh.
So it's interesting. Decentralization of mining is a common conversation, and it's important, right? That's what you're basically getting at, is that the centralization of mining is the concern, right? If miners as a whole, as a community, but as a disconnected community have this ability, well, that's almost in the interest of the network, right? Because everybody has this counteracting incentive and disincentive to harm the network. Whereas if we have 3 companies in China that have all the mining power, that is certainly of concern. The question is, how long does that really last? Because if more and more people are getting on board and the whole world starts to source this hardware to run these algorithms, and presumably we get better and better at creating more efficient chips, we don't necessarily consume more power, we just further decentralize the infrastructure of the network, hopefully.
Right, and I think that's a good point too. But also, I do know, let's say, I think the code by design too would actually help prevent this from really even happening. So like, let's say 25, let's say Antpool were to go shut off. Antpool itself were shut off, and all the miners there, they weren't coming back online. Then the difficulty will lower, and then whomever.
Oh, shoot. Hey, come back. Hang on a sec. Hey, you got cut off there. Brendan?
Okay, can you hear me now?
You got cut off there, yeah.
Okay, sorry, the internet at my school was kind of finicky. Anyways, what I was saying is the code design within Bitcoin, the difficulty adjustments that will happen if people were to unplug the miners for a prolonged period of time will make this sort of price war between miners and the price and who's behind the hashing power a little bit more even as difficulty resets. But at the same time, like you said, like, we're going to end up having to sort of come up with better chips, faster chips, and be sort of price stuck. But I believe, my opinion, that they have a heavily big influence into the price, but not a direct influence into the price. And what I would say, during the market drop that we had, about $4,000 was the cutoff limit for miners. And I believe that the price can go down there, but it won't stay down there for long, because the miners will be able to still be active onto the network. All that investment money in the back end will still be there and still make money, and hopes to one day have a more fair or return. So probably around, $12 a day ish. We haven't really seen about $12 to $17 a day for an S9 is kind of typical and kind of fair based on everything besides the huge jump that we had. So negating that. So when miners are back down to that $5 a day level and they're still operating and they're still choosing to be proactive into it, that's good. They're going to, so at the very, very bottom sentiment is actually looking upwards towards the price, going up and stuff like that. So, and even if the retail miners do get hit, the ones that do unplug, that'll go out and free up hashing space, lower the difficulty, and make it to where the people on the bottom who did stay in can last longer as well. So as more people just, unplug and stuff like that, that'll free up hashing space and make it to where they would earn a little bit more Bitcoin for the rest of the people who stay on. And then for everybody who has basically near free electricity and big mining rigs and big mining farms, and they have their leases paid out, they have their electricity paid out for years, stuff like that. They have money making schemes in all these different areas. They can probably negate the fact that Bitcoin would price plummet. They can sustain it for a lot longer than honestly any investor I know.
Right. Yeah, absolutely. Well, and now also with a lot of services coming out, we saw at the conference, Salt was one. What was another one? I've actually got their cards right here on my desk here. Celsius was the other one, that are both lending against crypto. So they're working with major lenders and banking institutions that are lending out, cash, fiat loans against crypto. And I think they said, I know Salt said that they have it set up to go up to 80% collateral, but they're really typically looking at 50% of the collateral can be loaned back. And when you start thinking about that, who obviously would be the most reliable player in this industry to loan to in that regard? The miners, right?
They would.
And so once the miners start establishing their, credit lines, which I wouldn't be surprised if some of them have already with certain banking relationships they may have created over the past few years, where, if there is a down, a fluctuation in the price like that, they would really have no problem hanging out for a year on credit,
It's great insurance, essentially.
Yeah.
And, if the deal is that we need to get this amount of Bitcoin or this amount of cryptocurrency back to the lender or the creditor, regardless of the price, we just have to give it back to them. Then, the miners will be able to do that for them.
Right.
And sustain this a lot longer. So, and if that were to be true, then when miners get certified and buy these loans and basically the whole the loaning industry, I guess you could say, I would probably bet that miners have a more important role now. They are basically the back end of a bad investment. Yes.
Yeah. Right.
And that would play an even better role for the miners to sort of get compensated. But whether or not they get compensated on top of, doing what they already do will be up for discussion, if miners are going to be doing that, or whether or not the people who take out loans have their own mining facilities and contract their work out from them. So,
cool.
And that goes into asking every single scenario that I think of. I always ask, like, is this a fair return for a miner? Is this, a miner is getting compensated, overcompensated, undercompensated, or not? Then if you can find that rate, then you can probably find that price in Bitcoin that it needs to be at. So, like I said, we all knew that Bitcoin was way overpriced at 20,000, and we all knew that the returns during that time were way too high.
Right.
And honestly, yeah, I mean, that's shown here. So,
right. And of course, if there are any miners that are holding their coin as they mine it through this time, this is the time when they sell it. When it starts to go, when it goes overvalued is when they'll sell it off.
Actually, yes. And I've been doing some more research to prove, why isn't this going in there? To prove exactly that that same assertion, because when the price exceeds the network hash rate, the amount of Bitcoin that they're getting, say, per day, it does change, but the amount of Bitcoin that they're getting per day, based on difficulty for the most part, they're not really getting more or less Bitcoin in a day, but if they're getting overcompensated in price, then
they're more likely to sell.
Then they're more likely, they have actually more incentive to sell, because if they're, let's say, back down before the rise right here, I was getting paid $10 a day, and I was getting 10% of a Bitcoin. Let's just pretend that's what it was. Yeah. And then over here at this price range, when it went over the hash rate, I was still getting 10% of a Bitcoin, and now I'm getting paid $40 for that same 10% of that Bitcoin. So my production hasn't changed. So essentially, if I'm operating at 14, let's say 10 terahashes, I'm essentially at this point in time when I'm over exceeding the network hash rate, I could say like, oh, I'm actually operating at a real 10 terahashes with an extra added 30 terahashes priced into it because I got, my worth is that much. So as a miner, I would actually have more incentive to sell my theoretical, artificially raised hashing power and exchange it for fiat because I'm not getting any more Bitcoin. I'm still getting that 10%. So why on earth would I want to hold at that point in time during this crossover? Why would being a miner? Why would I want to hold? Because I'm still getting the same amount of Bitcoin, and for that same amount of Bitcoin, I'm getting overpaid for it because I'm getting an artificially raised amount of speed based on price. So this crossover, and I'm working on this further on and stuff like that, and about these assumptions. But that's on the assumption that miners, they seek for profit. And most mid cap to large cap miners, that's what they have to do. They have to seek profit in order to maintain their facility, in order to maintain everything. So they're
that's an interesting dynamic. Yeah, sorry to interrupt, but that's an interesting dynamic that I've been also thinking a lot about. Is that is currently the dynamic in the market, but as more, say JP Morgan Chase has, a couple $100 million invested in Bitcoin or something like that, it's going to be in their interest to, put maybe $1 million or 2 or 10 into Bitcoin mining, right? As a hedge, right? Why not spend 10% of that investment in actual mining hardware in order to protect the network and better understand it and take a return in that way? And now you're talking about a little bit of a different set of incentives for a participant in the network. That may not exist yet, but arguably it's probably in development right now.
So I wouldn't be surprised that during this price range right here, going up all the way to 20K, that, I mean, you had the S7s and S5s, they were making money at this point. These were decommissioned miners. They were hopping on to the game too. And at this point in time, I wouldn't be surprised that large cap miners or large facilities were immediately turning their crypto into fiat and selling it to people as it was going up in value. Because at this point in time, their hash rate on a given day was overpriced. They were getting overcompensated. So, and they're getting overcompensated because, well, now for the same amount of Bitcoin, it's worth way more, and they're still doing the same amount of work. That's because it's based off they're getting the same amount of Bitcoin. So they're doing the same amount of work. They're not going overclocking speed at all. Nothing has really changed besides the price. So you can actually say like, well, hey, my speed back when I was getting paid, $40 a day. 10 days ago, I was getting paid $10 a day. Now it's 40. I got 4 times the speed. Well, it's only because of price, but now I have really, really good incentive to sell into fiat and keep fiat because it's more valuable at this point in time for the same return that I'm working for.
Yeah.
So that goes into work and utility, and that's why I believe that there doesn't lie a fair price and a fair return for a miner and a fair price for Bitcoin.
So then when that line crossed here, based on that theory, the miners would have stopped selling their coin. So,
right over here?
Yeah. So then would you then say that currently in this position we're in, then the miners are probably at least starting to hold a good portion of the coin that they're retrieving from mining right now?
In order for them to make more money at this point in time is for to increase their speed on when the hash rate is below, when the price is below the hash rate, miners could choose to upsize their mining speed, which will gain them more Bitcoin. So when the price is going down, essentially
that's when they invest in the latest, greatest, fastest hardware and overclock it and do this and that because they're getting it at a discount in a way.
Pretty much. And I'm trying to think exactly how to state this properly. But I would say in this point in time, miners, what they want to do and seek is they want to seek a sustainable amount of returns. During the peak, when they're overpaid, they want to sell into fiat because it's more worth it. When it's not,
hedge the downside.
they would rather it's more incentive to collect more of something. So I believe in mining, back when the price is going down, they're going to be collecting more of that Bitcoin for cheaper than you would in the market. And that goes into whether or not investors, people who are buying and selling, and miners, if you had two options during this price rise, which one would you actually choose? And I'm sort of getting into a lot of different abstractions of my theory, but
yeah, sure. No, I see that. Yeah, it gets really interesting when you start thinking about all the counter productions or counter incentives that occur there.
right.
And if they, if the miners start selling because it's overpriced, then that kind of accelerates because their sell-off triggers other sell-offs.
Now, I think miners might have actually played a role within this price hike.
Yeah.
But what role exactly? Well, they're doing the thing that they are meant to do, is make profit, which is not exactly a bad thing.
Right.
But because they have to.
Sure. And if S9's a year and a half out, is it not possible that some of these real big time miners are putting in hardware that's not on the market yet?
Oh yeah, no, definitely. There's definitely privatized firms that are.
You can see a pretty consistent raise in hash power happening there, which indicates that there was a reduction of sell-off as these points crossed early on, and they upgraded, right? They turned off some hash power and turned on some new hash power and kept upgrading hash power as the value of the coins went up. They were getting able to buy more hardware for their income.
Right, and then, but also you want to consider the source too. Some of the sources online, they get misinformation, like this right here. This could have been an error. Although these 2 points right here look pretty correlated to me. I would look on other sources to verify that this drop actually happened the way that it did.
Gotcha.
Because we can have missing values. People who have, I think sources that when they have all sorts of different types of values. So I would go ahead and verify that, and especially on pools that have tons of laggy values and stuff like that. So.
Okay, good points. Very interesting work you're doing there. So when do you graduate? You graduate end of this year?
December. So
December.
Right in December. So I'll be happy to. I'm going to go ahead. Yeah, I'm going to go ahead and try to release the paper around summertime and just sort of bring about what the model would look like and stuff like that. So, and actually see whether or not miners do have a direct or heavily indirect influence onto the price of Bitcoin itself. And then once I can tell people like, here, this is how you calculate a fair return for a miner, and here's how you calculate the fair price based on that. I would think that this will help the market significantly, or at least provide, the other side that miners would play a role in. Exactly.
So if we started a Vermont crypto investment fund, you'd be one of the advisors we'd want to be trying to recruit to join the mastermind.
That's my hope. That's my hope. And I really hope today in this conversation that I get whomever sees this podcast or video, that they get some sort of inspiration based off of this theory, but not for their personal benefit, but just really just to understand, like, there's something going on here. That's
right.
I'm trying to spearhead and get it done. And I'm going to go ahead and try to basically all the assertions that I would say in my paper are going to be proven, and they're not going to be left out with just like, oh, it's just because of this,
Right. Well, I think it's really important is just recognize the complexity of factors involved, where it's so easy to go, but what's the value of it? What's it based on? The only reason that's hard to answer is because it's a really complex answer, right? There's so many different parties and participants and incentives that influence the price of this thing that that part of it's actually, almost irrelevant in some cases in terms of the value of it, right? And yet the price correlation to all of these things is really, really interesting and really intricate. And that intricacy, to me, inspires some confidence in that this intricacy isn't by accident, and yet not by design either. It's really just a set of correlations of combining interests.
Yeah. So my basically my core objective, I got inspired by the cap-in model for the most part, and I saw what that did for the finance industry. And I know what I want to do for my paper is really just set the basis, the textbook example of what the pricing model for a decentralized economy might be like. So essentially in school, we hear about the pricing model of the cap-in, and it's just plain vanilla CAPM, nothing too fancy and bells and whistles. Now, other firms, they take the CAPM and they do all sorts of different things, put in this factor, this other factor, this other factor. Basically, my paper, what I want to do is simply have that textbook, plain vanilla pricing model that people all around the world can build off of and price it whichever way they want. And that's how it's going to work, actually. I mean, people, when they consider this factor or this factor because of new information that someone doesn't know, or this new information that someone so wants to put into the equation, then yeah, I want to see why not. They can do that, and they can plug it into the equation and then make it their own. That's what they do with the CAPM all the time.
Awesome. Just curious, have you done this on anything besides Bitcoin? Run it on Litecoin or any of the like science coins, like Folding Coin or Gridcoin or anything?
So this would really only work on the coins probably listed down here in this row.
Okay.
I know this would probably be, I know the relationship does exist for Litecoin, as I said earlier. When you're looking through these coins, you can try some other ones. But as far as I'm concerned, as long as I tackle, see, like here's Bitcoin Cash, it's all over the place for the most part. And I think coins do need some time to mature, like Litecoin, Ethereum, and Bitcoin, because over here at the very end, you see just this weird period that Bitcoin just hasn't matured yet. And Bitcoin is a prime example because there's been so much technological hardware that's been priced into Bitcoin since 2009. So you're talking about tech, 2009 tech, 2010 tech, 2011, and going on. Bitcoin is actually the safest. It's actually the safest return, consistent return for miners, because there's so much hardware on there that if people were to try to double the hash rate and which mean would double the difficulty and slash down your profits in one day, it's nearly impossible because the amount of equipment onto the network is higher than anything ever manufactured. No one can just pump out a bunch of miners like that at all.
That's really, what I love that you just presented too is like you've kind of just created a relative maturity correlation or index for the whole market, right? Like you could kind of look through, filter out unminable, like filter out tokens, but look at, mineable cryptocurrencies.
Right.
And you could come up with sort of a scoring that would give you a maturity grade for each of these different currencies.
Because as miners, like you said, when the position, like say people rely on miners for repayments and they become more important, you're going to want that in your currency. So if a currency, let's say, defaults, or goes down, then you had the miners to back you up. And there's a lot of them on Bitcoin. There's more of them on Bitcoin than there is on any other coin because it's been around the longest. And that's what goes into maturity. And like you said, like a scoring mechanism. So that does play a good role into like how sovereign maybe payments in cryptocurrency will become.
Right. I mean, everybody talks about like, complaints about the high cost of the payment, the transaction fee in Bitcoin. And arguably the whole Lightning Network thing can help resolve that. But at the end of the day, there is some elegance and beauty in the design of this system, not just in the monetary policy of Bitcoin, but in this whole combination of the miners' incentives and what keeps them operating versus the users' incentives and the market's incentives for the price of the coin. It's like a dance, and it really does protect the value of it. So all these like, oh, this is the next Bitcoin and solves this problem. It's like, man, I'm still trying to figure out what problem is that's being solved because I mean, to me, this doesn't really look broken. It looks like it's just finding more and more harmony as it matures.
Right. So I think you're totally correct. And I think the new coins, the tokenized coins, that's another concept of, ditching out the miners on the other end.
Right,
so who's going to fill that void of protection, essentially? So, as miners are they compensated fairly based off, the protection that they provide for financial reasons for whatever business that you're doing? So in my opinion, I do see as miners being like the very kind of like the last resort option, the life support for Bitcoin, essentially.
Yeah. I mean, like when a token project fails, where do you want to exit your coin to?
Well, then you would have to look for the central authority who created it, probably. You would have to.
I would want to sell it out for Bitcoin.
Right.
I mean, what I'm getting at is it just seems like there's a lot of projects out there, a lot of things, and at the end of the day, things are going to succeed and things are going to fail. Typically, the majority of things do fail, and ultimately, anybody in this market that's experiencing something that's failing is most likely going to liquidate into something like Bitcoin, whether it's Bitcoin or maybe they see Ether that way or Litecoin. But I think Bitcoin has the best liquidity and market stability and network protections for anybody to want to just put their savings dollars in.
That and that too, like how fast do you think that liquidation process is going to be? How fast do you think miners, if things were to go to crapshoot, how fast do you think miners will liquidate?
Right.
Well, it's going to take them a long time because they can hold out for a long time. As for investors, for tokens, if the token were to fail, they're, if they want to go into sticking cryptocurrency land, they're probably going to go back into a coin that has a miner back in there. Because if miners do play a very nice role, which I believe they do, in terms of providing stability, then I wouldn't see why Bitcoin wouldn't be a bad option.
Right. Well, plus they're going to liquidate into the market with the most liquidity, right? If they can't sell their token holdings for enough dollars or enough Ether to get the capital, they're going to sell it for Bitcoin because they know they can get enough Bitcoin for it on most markets. And very good work you're doing, man. This is really good stuff. Thank you for spending the time with me today. I think we'll call it a wrap for today, and I do want to maybe pursue future conversations as you continue to develop this. So let's keep in touch, and anything that we can do up here in Vermont for you. I did mean to ask you actually, as someone who's done some mining, as someone who's potentially looking at where your career might take you next. I know I shared a little bit about the work we're doing in Vermont to open up a legal entity for a blockchain-based limited liability corporation and some personal identity trust legislation. How does that strike you? I mean, you probably look at all the stuff going on around the country, but what do these things say to someone like you, someone who's about to graduate college, someone who's thinking about where you're gonna, put down roots, or where you want to work, or what kind of career you're looking for?
See, for me, I think it's a great idea what you're doing. And as for getting out blockchain careers or careers that are similar into cryptocurrency and beyond, because we know the applications are near endless for the most part. It's a great thing. I would totally, if I was up in Vermont and heard about this, I would probably like, hey, you have anything going on? I'll be interested, definitely. So I think it's a really good incentive. And as more and more people sort of learn about what blockchain is all about and cryptocurrency, then I would no doubt that this would have a positive impact on the community as well. So. Yeah.
And as a miner, I mean, one of the things that we're looking at is that, essentially miners are all kind of partners in a project, right? And so we're trying to protect them from personal liability if something goes sideways. And so from a legal standpoint, both as a miner personally, but also as maybe someone looking at a business that might want to establish an entity and do business with a state, you might live in Texas, but you might incorporate in another state. What does that say to you in that regard, in terms of from a business standpoint or from a personal protection standpoint?
Personal protection standpoint, as being a miner?
Yeah, I mean, it's something that most people probably haven't thought about so much, but like, if you're mining, right, you're participating in that network. If for some reason the Litecoin network shuts down, and then all of a sudden you get a bunch of people in the United States who like to lawyer up and go sue happy, place a class action lawsuit, and they start trying to subpoena identify participants in this network that failed, that cost everybody all this investment that they had in Litecoin. All of a sudden you're sitting there with a subpoena to show up in court because you're a participant in a partnership. That's the horror story that's being painted by some attorneys. And
well, I would say
part of the argument for us creating this protective veil of a limited liability corporation that recognizes a blockchain-based organization.
I would say, sorry, you cut out a little bit. I think the Wi-Fi.
Oh.
But from what I got is, so if Litecoin were to go to zero tomorrow, for the most part, there are other multi-algorithm coins out there that are in the scripting hemisphere that will yield better results. And there's actually profit switching pools that miners would go to. And I mean, honestly, you're actually really not even getting that good of a return on Litecoin on its price right now. You can go to whattomine.com and figure that out. So I believe there's going to be other coins out there that'll suit the needs for miners, because miners are seeking profits only.
Yeah. So yeah, the piece that I got cut out on was, then I'm talking about crazy sue happy Americans that decide to create some kind of class action lawsuit against any participants in the Litecoin network for their loss on their investment in a particular coin.
Hmm.
And that's what we're trying to create, some sort of
I
at
would say
least conversation legally to be able to protect people from that type of, in my case, in my opinion, frivolity.
Yeah, I mean, I would say try and prove it. Exactly how do miners play a role into the price in Litecoin is actually, and that kind of ties into what I'm doing right now. And I would say, based on the research that I'm doing now, the answer is no. Miners don't play identical, like a direct price influence onto the coin.
Right. They have an indirect influence.
Heavily, I think it's heavily indirect. But until towards the law on that point, I don't know how they can spin it in court, saying like, oh, hey, miners have a heavily, indirect action onto the price. But there's lots of other dynamics too that miners do play, other than just simply hashing power, fair returns, and stuff like that, and compensation. I'm basing most of my research off of compensation, but miners, they can actually vote and accept a new upgrade on a coin, and they can decide not to. They can decide to completely not mine at all on this coin and switch to another coin. And I think tracking that in general would be extremely hard to do, and hard to justify in court, saying like, hey, I was responsible for my actions as a miner and towards the investors that were seeking investment into that coin, when I was probably mining that coin for a split second and then switched to another coin and then switched to another coin. So as miners, that's what we do. We seek profit. We don't seek technology. We don't actually care about the underlying technology at all, honestly. And I've asked people who have big farms and out there, like, hey, I know you're pretty much all this for profit. He's like, yeah, pretty much. Like, I actually don't give a crap about the technology. He's like, no, I do, but at the end of the day, I don't.
Right. Yeah.
They have a bill at the end of the day. They need to pay it off.
Yeah, exactly. Awesome. Well, again, thanks for the time on here today. I appreciate it. I'll definitely be in touch. Definitely want to keep track of how this whole thing evolves, and keep me in mind. I think that we can definitely work together in various ways in the future. So
absolutely, thank you for having me on here.
Yeah, awesome, Brandon. Hey, take care. Thank you all for joining us tonight and for enjoying the show and joining the conversation. This is Ryan Munn, and this was Brandon Jaggers. And have a good night.